Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Merger Monday, another M&A trade. I like to see it. This time, Keurig Dr Pepper agreed to buy JDE Peet for 15.7 billion euros to bolster its struggling coffee business. They're not done. Then Keurig Dr Pepper will separate its coffee and beverage units into two independent U.S.-listed companies once the deal is completed. All I hear is the cash register ringing for the bankers and lawyers. Let's see what's going on here. Ken Shea joins us, senior consumer analyst at Bloomberg Intelligence, safely ensconced down there in our Princeton campus. Ken, talk to us about Keurig Dr Pepper. What are they trying to do here?
Yeah, hi, Paul. So this two-step deal basically addresses a lagging division they've had, the Keurig coffee business. You know, it's cold beverage business, namely Dr Pepper, Mott's, Canada Dry, is doing really well. Whereas the Keurig coffee business really has been a laggard over the last couple of years. Now that you have higher green coffee costs, you have 50% tariffs coming in from Brazil, namely coffee beans. Slow demand for at-home, pod business, the ubiquitous K-cups. And it really has painted a dismal picture for that division in the second half. So rather than try to sell it, and I don't know if they try to do that, but rather than try to do that at a low multiple, what they're trying to do cleverly is team it up with JDE Peet's, which is the number 2 coffee producer in the world, behind only Nestle, but mostly big in Europe. And, attach the essentially U.S. business, the K-Cup business together, and you have a pretty good entity.
You know what struck me when I was reading about this deal, guys? Dr Pepper was the second most popular soda in the U.S. last year.
Is that right?
Behind Coke and ahead of Pepsi.
I did not know that.
I can't remember the last time I drank a Dr Pepper.
Well, if you're in Texas, that's like the state drink down there.
Is it now?
Yes.
All right.
Yep.
So, but Ken, the question here is, talk to me about the beverage side, the soda side here, because I know bottled water has sort of been eating their lunch, the overall industry, right, for years now, outpacing the sales of soda. So what's the health of that side of the business?
Oh, it's doing very well, Alexis. The cold beverage side is doing really well, whether it's Coke or Pepsi or Keurig Dr Pepper. Particularly those 3 companies, because distribution is everything. These 3 companies have national footprints, so they can reach all the outlets, whether it's fountain drinks or traditional supermarkets, vending, whatever. They can reach it, and they all have powerful brands. As you said, Dr Pepper has really been coming on strong over the last couple of years, and they have other powerful brands. And unfortunately, their somewhat mini conglomerate business structure is being dragged down by Keurig, the coffee business. So that business is doing really well. Keurig has shown that it's also flexible and willing to pivot to fast-growing niche cold beverages. It's a business that continually changes with consumer tastes. Over the last year or so, for instance, energy drinks have taken off. So what they do? They went out and bought Ghost Energy, for even a younger demographic that typically drinks energy beverages. They are bigger into the sports drink category. They talked about on the last call a few weeks ago to get stronger in the protein space. Everybody wants protein. The GLP-1 folks need protein replenishment. So they've shown a willingness to branch out and tap into anywhere where fast-growing cold beverages are, doing well.
So I look on my global commodity screen and I see the price of coffee is up like 25% this year. I mean, what's going on with that? Talk to us about coffee and just the cost of the beans and all that kind of stuff.
Well, coffee beans are essentially sourced from Brazil. So to some degree, the roasters are hostage to good crops. And over the last year or so, you really haven't had great crops. I think some of the sellers in Brazil are also holding back, knowing that tariffs are coming. And they're not going to get what they would like to get, and that's exacerbating the run-up that you've seen over the past 6 months, a year in coffee beans. If you went back over the last couple of years, 2 or 3 years, you would see that the retail price of coffee, whether it's ready to drink or hot coffee at your local coffee shop, have increased faster than most other beverages, soft drinks I'm talking about. So you're even seeing some consumers bypass or switching from, say, like cold coffee to move to energy drinks. It's more cost effective. So the coffee producers have a conundrum. Do they continue to raise prices and get flat or lower volumes, or do they eat that margin? And so what Keurig has decided to do is kind of divest it in a tax efficient way.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Deals. The Pinault family is said to explore options for selling perhaps its sports brand Puma. And I looked at the Puma shares. They trade in Germany. They've lost like half their value. I don't know what's going on over there, but Poonam Goyal does. She's the senior U.S. Retail Analyst for Bloomberg Intelligence. Poonam, talk to us about Puma. What's going on with that brand and why the Pinault family and maybe looking to sell here?
Yeah, so I think Puma's come under a lot of pressure in the last 2 years, especially since they lost their CEO to Adidas just about 2 years ago. What's happened is that Puma was able to thrive when Nike had pulled out of wholesale as they regained a lot of that shelf space. But now with Nike pushing back and really entering wholesale in a more meaningful way, Puma doesn't have that same visibility in wholesale. So their wholesale sales have struggled, and they really haven't found a niche for themselves to grow the company from where it is today. So lots of pain points. I think, with a sale, if there is a sale, that is, it might just give it a bigger lap to fall into, giving it more scale to leverage and maybe allow it to grow a little stronger.
I'm curious about endorsements because I just don't feel like I see it with Puma in the way that I do with a Nike, certainly, or Adidas. I mean, I think I saw Dua Lipa out there hawking, I don't know the connection there, but hawking Pumas. So are they behind the curve when it comes to what can be really vital endorsements?
So vital endorsements are critical in the game of sports. And you're absolutely right when it comes to mainstream sports that we're used to, like basketball and soccer and football. Puma doesn't have as big of a play there as Nike and Adidas. But Puma has crafted itself into the smaller sports, like cricket, for example. It endorses one of the largest cricket players in India for cricket. It has the Ferrari sponsorship for racing cars, right? So it does participate more meaningfully in the smaller sports, you might want to call it, versus basketball. It has LaMelo, but it doesn't have really that much more in terms of in the other mainstream sports like football or others.
Who do you think should, if this company is put up for sale, who do you think should buy Puma?
That's a tough question. I mean, it's probably going to be, right now it's speculated as Anta Sports and Li Ning. And I think those are all possibilities because they have the room to take in a brand that wouldn't have as much overlap, right? It's the predominant brand. It could help them scale their own visibility. I don't think a Puma makes sense for a Nike or an Adidas, for example. I don't think that's where it belongs, but I think anywhere else is fair game.
If they don't sell, what are the other options on the table here?
I think it's just going back to the basics, right? I think it's going to be harder for them to compete with Nike and Adidas because they don't have the dollars or the deep pockets to advertise and market as aggressively as the other two do. But they have to stay true to their niche markets and really craft their way up from there. It's going to be tough. Look, the athleisure market is getting more competitive. Everyone is trying to sell athleisure, right? Whether it's the specialty apparel retailers or the mainstream retailers, whoever it is, they're all going after that market share because the market is growing. It's not going to be an easy ride, and they have a new CEO in place to help them drive the turnaround. But we haven't heard a strategy yet, so we're not sure what their intentions are and what the roadmap is to really drive this turnaround, at least yet.
30 seconds, Poonam. Who's the Pinault family? Who are they?
They own about 29% of Puma shares, so I think they're an investor that's largely invested there. But I would say there's a push to get the sale going because of the underperformance that they've had.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Believe it or not, Apple is just weeks away from its biggest product launch, or one of its biggest product launch ever. They're calling it a once-in-a-generation iPhone overhaul. What does that really mean? What can we expect? Anurag Rana, Bloomberg Intelligence technology analyst, coming to us live from our Chicago bureau. Anurag, thanks so much for being with us. Look, I'm the kind of person who holds on to her iPhone, okay? I don't have to run out and buy the latest, greatest. I will have it for years. Why? Because there's not really a compelling reason, oftentimes, to upgrade unless I'm looking for a better camera. So tell me, what's going to get me to go out and buy these new iPhones?
Frankly speaking, most of the Western world, that is still the story, is you will go and change when your battery's not working properly or there is some issue with the screen. However, every time there is a new model that shapes up, comes out, there is some excitement. And it seems that this time, Mark Gurman's done such a good job reporting again that they'll be launching called the iPhone Slim or the 17, which is like a iPhone, just like a Mac Air Airbook. It's a slimmer phone. It's going to be replacing the iPhone 16 Plus. So still the base end model, but I think that is the one area where we are seeing something new come out of Apple iPhone, which has not been the case, I think, for the last several years.
So, again, what can they really do here? Is there something? I kind of think that phone's fine. What are they looking to do? What are they looking to achieve? Are they looking to address some shortfall?
It typically targets more the emerging markets, more the Western world. When you look at some market like the US, it's pretty saturated in terms of unit growth. What can happen in the US mostly is people may decide to upgrade to a larger SKU with more memory or a better camera, and that just leads to higher average selling price. But in emerging markets where the cost basis or the entry level point, you're giving them something new, something cooler, perhaps in a new color, that's what brings in more people to the ecosystem. And then over time, they can go from the base model to the Pro model or the Pro Plus model.
What about this foldable iPhone? I know that Samsung did it with the Galaxy, but that was like 5 or 6 years ago. So Apple's a little late to the game. That happens sometimes. Apple's not always the first to market, but it sort of takes over the market once it enters it. So what can we expect from this foldable phone?
Yeah, but that's not going to happen till next year. Mark Gurman said that that's the base, or the slim model is the base of the foldable phone, which is going to come out next year. So Apple's still behind on that end. But Apple has an argument that they will not go unless they are absolutely sure. They don't want to give the users a bad experience. And their big issue has been that when you fold that phone, there's a slight crease in the middle, and they really don't want that level of technology. Another thing they've done is using their own modem in this case, rather than the one they're using from Qualcomm. Apparently, that helps them to slim the design or the size of the phone. And, that, again, puts the base for next year's foldable phone.
There was a time when people would get excited about new product launches from Apple. That feels like 10, 15 years ago. All people want to know about is AI. What's the AI strategy? What's the nuance from recent discussions with Apple about kind of their AI strategy?
Will Siri get any better, please? Please.
I think this is, it's people, if there's one tech company that's made so much fun around AI, that's Apple in the last, 1.5 to 2 years. But I still go back to say that this is probably one of the most important distribution systems out there in the world to get mass adoption of consumer AI applications. So Mark's done an amazing job again to talk about what they're doing in that case. Is on Friday he reported they are working now with Google to get their Gemini models in. And frankly, that has been our hope that down the road, if there is an agreement between Google and Apple to get their Gemini models in the ecosystem, I think it's going to help Apple defend that hefty fee that they generate from Google, which is under scrutiny right now. But it seems to me that based on what Mark has said, that they're going to be working with OpenAI, Anthropic, and Google, and these are the three companies with the top models right now. So whether they use it in one particular area, whether it's whether that's the headphones or whether it's on device, whether it's sending stuff to the cloud, I think if they can't build it themselves, they have the capacity to outsource it to one of these experts.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We want to dive into a broadcasting deal that was announced not long ago. Nexstar buying its rival Tegna. It's a $6.2 billion cash transaction. Works out to about $22 a share. I think that was about a 30% premium when it was first announced. Shareholders seem to like the idea, but will the government? So we've got Jennifer Rhee here, Bloomberg Intelligence Senior Litigation Analyst, to break it all down for us. So Jen, once upon a time, there were rules about how many stations
Once upon a time.
one company could own. Will this FCC approve this deal?
I think in the end, yes, because the timing was right. This isn't a deal, I think, that these companies could have gotten through a few years ago during the Biden administration.
Absolutely.
But both of the rules that the FCC has that would get in the way are in the process of being changed as we speak. And Republican commissioners have for a long time wanted to change these rules. So the first one is the 39% ownership cap, that one company can't own or operate TV stations that reach more than 39% of U.S. households. These companies say they'll reach 80%. So it's just clear on its face that there's a problem there. But the FCC is in a rulemaking process. They'll probably have this rule, get rid of it, vacate it, we think by the end of the year. My colleague Matt Chettenhelm is an expert on the FCC, and we've talked about this quite a bit. That's probably going to clear out of their way. There could be litigation, of course, but we do think the rule will move out of the way. The other issue is owning more than one of what's called the big four broadcast stations, ABC, CBS, NBC, Fox. That rule would also get in the way here, probably in a number of local areas, called designated market areas by Nielsen. That rule has also been vacated by the Eighth Circuit Court of Appeals. It will also probably be in litigation, but it seems like the road is clearing for the FCC there.
It's a whole new world.
Yes, it's a whole new world. But we have Department of Justice also. So we can't forget that.
Right.
We always think about the FCC. The Department of Justice is going to be looking at this too. But I do think they can probably get it cleared through that agency as well.
All we really care about is President Trump. Has he voiced any opinion one way or the other about this type of deal or these types of deals?
I haven't heard anything from him. It would be reported in the news. I haven't heard him say anything about these deals. We are beginning to see a trend, though, in the merger world, Paul, where if the companies do and say the right things for the Trump administration, they're getting assistance in getting their deal through. And they're all pretty well aware of that. So as long as they do and say the right things, hey, we won't block political ads, we'll be neutral in, our censorship of content, things like that resonate with Trump, that's going to help them.
Sinclair did come in here with an 11th hour deal, did they not?
Yeah, I think so. But,
But they rebuffed. Why? It seemed like on a per share basis, it was better than the Nexstar deal for Tegna. So why rebuff it?
I can't speak to that. That's much more Tegna and Tegna's strategy. Maybe they think from an antitrust perspective, there's less overlap here. I mean, it is 35 of 51 of their DMAs. That's what Tegna says. But in those 35, depending on what stations they own, that overlap may not be problematic. It may only be problematic in a few. They may still have to divest some stations in order to get Department of Justice approval. I haven't done that comparison analysis, but it may be that they have to divest fewer stations for this deal, perhaps than a different one.
Yeah.
How is the Department of Justice when looking at mergers and acquisitions generally defined, has it materially changed under the Trump administration versus the Biden administration?
You know, it's so interesting. The rhetoric at the beginning was that it wouldn't change, that there would be this read-through and that there was more commonality with the Biden administrators than differences. But it has changed. You know, they have gone back to settling problematic deals with, you know, structural, even one behavioral remedy, that was Omnicom Interpublic, with divestitures. This is something that wasn't happening during the Biden administration. They just said, if a deal's problematic, we're going to sue. This DOJ and this FTC has said, no, we're going to work it out. If we have problems, we'll work out the problems with a fix, we'll have a settlement, and we'll allow the broader deal to close. And that's a big difference.
What does this deal tell you, though, just about the larger landscape of television, especially local TV, which we know has been losing revenue share? They're struggling just because there are too many places the eyeballs can go, right? And
That's right.
They're competing with streaming and with the big guys. So is this really a merger of necessity for these local TV stations?
You know, I would think it is, and I think we're going to see more. You know, that kind of consolidation has slowly, there's been quite a bit of consolidation, actually, over the years. It kind of slowed down during the Biden administration. But, you know, I think it's going to pick back up again because they are so challenged by cord cutters, by people who never, you know, younger people who never watch TV at all.
Cable,
you know?
what's that?
What is cable? Exactly.
So looking broader here, I mean, over the next year or two, do you expect to see more deal activity just because companies and boards and private and all the forces out in the marketplace feel like this is the time to do it? This is an administration that will support deals?
I think so, and I think it would have already picked up if we didn't have so much tariff uncertainty. I think that has slowed things down, but as those things sort of work themselves out, I think we're going to see a lot more deal activity because you can see a path to getting these deals done without having to go to court and without dragging it out for 2 years.
So this is sort of a litmus test then, isn't it? This Nexstar Tegna deal.
I think it
for
is.
the rest of the industry, really.
Yeah, I think we have a few litmus tests out there. You know, the Google Wiz deal that's pending is a litmus test for sure to see what this administration will do with a big tech platform merger. I think this Nexstar Tegna deal is a litmus test because they're breaking all these old rules that were the orthodoxy for years. We're going to see where that goes. And then, you know, you have Dick's Foot Locker and you've got Charter Cox. And there are a lot of big deals pending right now. And I think they all are deals that would have had trouble during the Biden administration, but I think can get cleared now.
Here's a deal that Charlie Pellet actually mentioned to me just recently. What was it? The Spirit Airlines and was it JetBlue? Or somebody? I mean, some of those deals that did not get approved in the Biden administration. Do they bring them back, thinking that maybe they can get a more favorable ruling this time? Is there an expectation we might see some of that?
You know, I think it's possible. Yeah, that was blocked by a judge. So the department did win a lawsuit in that case to you know, basically block that deal. You know, it's possible that they try again because you have a very different Department of Transportation, which would have to approve that. You have a very different Department of Justice. And again, you have an opportunity to divest and get a deal cleared. And maybe at this point, there would be structurally different deal because they could divest certain routes or something like that.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.